Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Rick Ackerman, editor of the newsletter Rick's Picks, his website rickackerman.com. Welcome back to the show, Rick.
Always a pleasure to join you. Let me mention that I'm not in my usual South Florida location. I'm about as far as you can get from there in the U.S. I'm up in Landoff, New Hampshire. And even though you've never heard of Landoff, it's got a rock-solid economy here. They've got a gigantic factory that makes, it's called New England Wire. And they make specialized wire. NASA buys a lot of it. And their main imports, resource-wise, are gold and silver. And they use it to fashion high conductivity wire. And the workers they took the company private, so it's got a workforce that owns the company. And for a small town, they've got sort of bedrock industry here, and it's sort of a pocket of prosperity in a place where you wouldn't expect to find it.
Yes. So, speaking of gold and silver, gold was way up today. What's behind that?
Not way up, and that's what I like. I'm now in love with gold. I've been preaching caution for so long because, we've all gotten familiar with the gold just gets up to the threshold of where we're encouraged, and then the boys take it down for $50. And this has been a feature of gold's bull market for some time. I don't think there's been any doubt that it was in a bull market, but it's just been biding its time, gold and silver, waiting for the idiotic idea to pass that somehow Bitcoin is a better store of value than gold or silver. So whatever inflation everyone is expecting these days, it's now the hedge is finding its way into bullion, and I think that we've moved finally off the launching pad, and you can see that the uptrend in gold, the bad guys aren't able to take it down for $50 in a day. I'm not going to say they won't be able to do it at all, but those shakedowns, of course, were there to create bargains as gold has kind of painstakingly made its way higher. But I think it's going to be less painstaking now, and I'm using a 2085 target, I believe it is, for the June COMEX contract. In silver, I've got a more immediate target at 31 and change, and the bullish target of another larger pattern takes it up to about 35. But I'm finally at the point of saying it's going to get there. Don't worry about it.
Now, what's the reason for gold becoming popular again?
Well, I think it's two things. We were only going to have so much of this quote-unquote fear of inflation before we started, investors and speculators started returning to gold and silver as a traditional hedge rather than Bitcoin. And we've seen Bitcoin come in for some hard selling recently. I think it reflects a condition where not only are Bitcoin speculators a little less in love with Bitcoin, but they're finally getting a sample of what can happen in respect of corrective price action. When it was up around $60,000, pretty much everyone who owned Bitcoin was thinking $100,000 would come easy, but at this point not so easy because it already has corrected down to 30,000. So anyway, I think that speculative action in a hedging way has finally shifted over to bullion, and it's going to make it a lot less painful for long-time gold investors to enjoy this bull market. And I think the other piece of it was just kind of hinted at or more than hinted, but there's a piece by a fellow named Alistair McLeod out on Zero Hedge, and he's essentially saying that that certain institutions, quasi-governmental, that regulate the gold market and the banking system, are finally seeming to want to draw a distinction between paper gold and physical gold. And the bullion banks, of which almost a couple dozen are registered with these regulators, make considerable sums of money pretending that the physical gold that they have can create almost infinitely is real gold. It's a claim on real gold. And nobody has ever bought that sham, but the regulators have never really come in and said, well, you can't do that. So they're now stepping in to do that, to say, look, you know, you're no longer going to have the benefit of all this paper gold that you can create out of nowhere. And that's going to hurt the bottom line. But it's also going to constrain the supply, the paper supply of gold, meaning if you want gold, you're going to have to deal more and more in the physical, and there's going to be relatively little carry trading and arbitraging against paper gold that comes out of nowhere. So if that's the case, it's a very bullish thing for gold and silver.
Now, when you talk about physical and gold, can you maybe just define which is which?
Well, the bullion bankers claim that that all the paper gold is it represents claims against the real stuff, but of course there's not nearly enough real stuff that you can get your hands on easily that claim could be true. So you know, the regulators are saying it's really just derivatives you're trading, isn't it? So and you know, one of the reasons McLeod raises the question, well, why would the regulators want to step in and destabilize a market that has flourished for a long time? And he comes up with a pretty logical answer, and that is that the big time, the official institutions of banking, namely the central banks, the Federal Reserve, are a little tired of having all this side action going in the commercial banking system, the creation of derivatives for this or that sets up a kind of feedback loop where you know, the banks are destabilizing the credit system by being able to create a lot of side action in things that are thinly collateralized like gold. So it's a way for the central banks to gain much greater control over the money supply without the static, the interference of derivatives markets that sometimes become the tail that wags the dog.
Now, in that case, does that mean if you wanted to see the price of gold go up, just start demanding some real gold to be delivered on that gold paper you hold?
Well, that's effectively going to be true. You know, it's hard to account for where all the gold, the tonnage that gets traded each day, goes, and how it's used, and how much of it is demanded for industrial, how much for hoarding, and this and that. But by and large, if the bullion bankers are no longer able to create paper gold willy-nilly, it has to. The demand for it has to feed into physical supplies of gold, which has to push the price up.
Now, if that happens, how much do you think the price of gold would go up? We always keep hearing impossible prices, 10,000, 50,000. Would there actually be a run like that?
I was never a buyer in those numbers. You know, I've always felt that come hell or high water, an ounce of gold is going to do you just fine as far as buying the necessities of life, even in the worst of times. So I don't sort of focus on pie in the sky, if that's what it is. And you know, I've always told my subscribers, if they think they're going to, when the world finally does go to hell in a handbasket, if they think they're going to trade a few Krugerrands for things that really are valuable, like farmable land, they better have a glib tongue talking to the farmer that's going to accept a handful of coins and just fork over some good farmland. So, and for that matter, you might not even be able to buy, in the worst imaginable times, you might not be able to buy a loaf of bread for a Krugerrand. So it might be 2 Krugerrands when the bread truck comes around. So I never thought it was useful to think of gold in terms of $10,000 or $20,000 an ounce, but more as a hedge against the worst possible situation, economic and financial system that you can imagine, and it's coming. It's definitely coming. You know, everything is so pumped right now, and it's not inflation. It's really an asset bubble, and that's where there's some confusion too. You know, during the 70s, inflation came from an organic source. It truly was a spiral. We had wages pushing prices, and prices in turn pushing wages, and the inflation in that way came organically. In this case, the inflation comes really just from an asset bubble where all of the spare money is going into the stock market and a couple of other places. And it's unlike inflation, the asset bubble can collapse into what would be fundamentally a deflation literally overnight.
Now, do you see that scenario happening?
I don't see it as being even remotely possible of avoiding. You know, you look around, really. You've got everybody. We've talked about a lot of the factors that are the things that are going to be essentially ticking deflationary time bombs. We've discussed everything from the superheated real estate market, the inflation we've got in real estate, to the pension system, which cannot possibly be inflated through monetization. So in those 2 critical areas, the pension system and real estate, all the pumping in the world isn't going to reinflate those things once they start to implode. It'll be sort of when you start getting sucked into a black hole, it will be like trying to extricate yourself. But once the tug of deflation begins, it will be irresistible. But for now, we've got the illusion that all of the stimulus, which is certainly spilling into consumer goods, is going to be a trend, but it's not. You know, the much bigger, the big enchilada is really deflation, and it has to do with the value. And the biggest piece of it is the derivatives market, where we're talking about deflating a $2 quadrillion house of cards.
Consumer confidence in Canada is at an all-time high, and whenever they do a survey in Canada, when it comes to social or economic trends, they tend to mirror each other. Are consumers in the U.S. also very confident right now?
Yeah, but when can you think in the last 300, 400, 500 years where an excess of confidence did not lead to a bust? I mean, it's axiomatic that at the top, everybody's going to be at their most ebullient. So I wouldn't read too much into consumer confidence other than the fact that we're probably closer to going over Niagara Falls than you might imagine.
We'll have more with Rick Ackerman right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Rick Ackerman. Rick, if we're about to go over Niagara Falls, what kind of a life jacket or barrel should we be in?
Well, this is something you and I have talked about for the last 2 or 3 months, and I haven't changed my mind really. I'm talking about a barbell hedging strategy, and you start with two assets that everybody has hated. One of them is obviously less hated these days, and that's bullion. But the two sides of your hedge are gold, and the other side is treasuries. And of course, treasuries are still despised. So if you think it through, either to a hyperinflationary end, which I see is more or less impossible, or a deflationary end. Deflation is obviously going to be good for bond holders, but I think it's gold holders are not going to suffer either, because deflation is cataclysmic, and gold is certainly an asset to hold against cataclysm. So I think it's just a great do. I stopped short of saying the bonds are about to turn and the dollar, but they're certainly very unpopular trades right now. Everybody's, when I mentioned earlier, when was the last time consumer confidence had reached some threshold of giddiness when it wasn't indicative of a top or near top? But in the same way, when everybody shuns a couple of particular investments, that's really why you got to be there, and a little bit ahead of the event. So we've got sort of a good cover to get in right now. Everybody still thinks we're going to have this runaway inflation, and they're really just sort of reading the superficial symptoms and drawing the obvious conclusion from all this federal, the government stimulus, monetization, and fiscal stimulus. But it has its limits, and to a significant extent, it may be discounted in the markets. And also at my website, rickackerman.com, my commentary this week is a very bullish take on municipal bonds. And this comes from a good friend of mine in Boulder, a financial advisor, who from the 1980s on did brilliantly for his clients just by holding the course in treasuries. And I'm not quite in agreement with him about munis. I do think there's a default risk that's going to come out of things that were set in motion by the pandemic. There's just the tax base of a lot of cities has been eroded. But the bullish case in munis is based on a couple things. Number one, that the inflation that everybody's expecting is not, it's going to be, as Jerome Powell put it, and believe me, he doesn't get it right too often, but it's going to be transitory. And, the other part of it is that all of the stimulus money that went to the states is going to ease the burden on cities to float bonds for this and that. So the supply of munis will be somewhat reduced from that, and the inflationary impact on munis will not be quite what everybody has thought it to be. And if you thought that way a year ago, you would have had a great year in munis, because everybody overestimated the effect of the pandemic, at least so far, on municipalities and their revenues. But anyway, my friend Doug says there's still plenty of room in the tax-free municipal bonds market, and that, of course, raises another advantage of these munis, namely that they're not taxed as for federal tax purposes income, and they also avoid the 3.5% levy against essentially the wealthy for it was the Affordable Care Act surcharge on income from investables.
Now, there's been talk that they're going to start treating Bitcoin transactions like any other transaction that is designed to gain profit, so you'll get capital gains tax. Is that throwing cold water on the cryptos? Oh, you bet.
You bet. A lot of people, maybe the same ones, deluding themselves into thinking that crypto gives them cover for whatever black or gray market they're operating in, that they can hide their income. Well, that's always been a ridiculous idea. And but if they're starting to treat the gains in Bitcoin as capital gains, it's quite a, it adds a whole big fat layer of red tape to the game. So it's not a deal killer, but even the big guys like Paul Saylor and Tudor Jones, they've kind of backed away. And of course, Elon Musk's his newfound environmental religion about all the energy it's taking to extract the last of Satoshi's 20 million Bitcoin. It's an ecological disaster. So Bitcoin's been hit by kind of a perfect storm of negative news, and typically when that happens, you think, well, the big boys are just sort of orchestrating a collapse so that they can build their positions again. And I think that's true. I think there is some institutional support for Bitcoin, and we'll make a bottom and we'll rally again. But this time around, there's going to be some thick supply up around 60,000 where Bitcoin just topped.
Do you see a deliberate boost in interest rates to cool what has become a red-hot real estate market in both Canada and the U.S.? The last report I saw is that the U.S. real estate market hasn't been this hot since 2005, and we know what happened then.
I don't know about hot, I mean, prices are going up, but it doesn't mean that the number of transactions is increasing. And in fact, that's not the case, because new homes they're out of reach right now. I read somewhere where the increase in lumber prices alone has added $35,000 on average to the construction of a new home. And someone was telling me what the price of a one board of plywood 8x4 is up to something like $90, 5 or 6 times what you might expect in normal times. So when we talk about the real estate market being red hot, it's not. We can't even get the materials to build a lot of houses. And so you have the worst kind of hot possible, and that is just an insane upward skew in prices for existing homes. And but as I said, nobody's even building them anymore. Even the glue sniffers in private equity, who for a few years there were building and buying homes like crazy just to rent them to people who can't afford their own homes.
Now, I also saw a report that said, yes, prices are way up, but people are not putting their houses up for sale. I think a lot of people like where they live and they're not willing to sell, and it seems like for any price.
Right, and it's not just a question of liking where they live. It's like, where would I move if I sold? So everybody's sort of locked in, and prices are going up with transactions kind of flattening out. And you tell me where that all goes. It ain't going to end well.
Could you see another crash like the 2007 housing crisis without the robo-signing of mortgages?
Yeah, I've been seeing that for 35 years, really. And in the crash of 2007 and 8, we got halfway to my target. All along I've said we'd have a 70% collapse in real estate that would be even worse in vacation properties. That would be closer to 90%. And so we got half of that, a 35% haircut in the average home price in the U.S. 12 years ago. But now we're even more pumped than we were then, and I think the next housing crash, which is inevitable, is going to get us the full 70%. And of course, it's going to be much more difficult to extricate ourselves from an abyss that's twice as deep as the one in 2007 and 8. So this will be the big one that's coming up. And it's one other reason why I continue to say that the main feature of the end game will be deflation, not inflation or hyperinflation.
Rick, thank you so much for chatting with us.
Oh, always a pleasure. And let me apologize if you're getting the background noise. They're cutting some big trees down on the property where I'm staying. I'm staying with the former Silicon Valley guy who decided to buy some acreage in the boondocks of New Hampshire, just in case. He's been waiting for the big one himself, and so he's just laying in supplies of different things that could keep him pretty well. He'll be set for a couple of years.
Rick, thanks again.
Always a pleasure. Again, thanks for inviting me on, Jim.
My guest has been Rick Ackerman, editor of the newsletter Rick's Picks. If you want to go to his website, it's rickackerman.com. Any questions for Rick can be sent to info@housestreet.com, our YouTube channel, Talk Digital Network. Find us on Twitter @HouseStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.